Hi, this is Mark Item with HONU Trading with a weekly review for the week of May 22nd, 2023. Educational purposes only, no recommendations to buy or sell. Make sure you know your time frame and risk tolerance. Job one is always risk management. And towards the end of the video, I'll give you a different way to think about that in terms of whether I should even take a trade or not. Follow me on Twitter at HONUMGMT, at HONU Management. And if you find this valuable, take a moment to like and subscribe. So today's agenda, just like last week, I'm going to spend a little bit of time up front talking about this first bullet point. If the Fed is going to cut, bad things are going to have to happen. So far they haven't. But if that's what's going to happen, then bad things have to happen in order to get the Fed to cut. The market knows all the bricks in the wall of worry, and yet we're still climbing it to some degree. The debt discussions, the debt ceiling, the banks, the high but slowing but still persistently high inflation, political gridlock. So is the market unstoppable? And sometimes I've seen people on Twitter talking about, wow, new bull market. Is it unstoppable? No. Breadth is flat, and that's a big improvement this week. The biggies are still bullying the smalls, but at least breadth is flat. We actually had positive breadth on the week. We're still in the risk on, risk off, what kind of market, but getting better and getting closer to being risk on. Financials aren't out of the woods yet, but they're closer to the edge of the forest. And then finally, the earnings game we're going to play again, jacked or whacked. So I've seen a lot of people say this is, new bull market. Are we unstoppable? Well, no. This is the bull we want. I want to be a bull. I want to be a snorting, roaring bull. Unfortunately, this is the bull we've got. He's on the field, but he's not exactly killing it. Now, the bear, however, is actually a little sleepier, a little tired this week. And the breadth, while it has to pull its weight, we actually had better breadth this week, plus 57, compared to minus 364 last week and nearly 900 the week before that. The way this played out was a little interesting, and we're going to look at that on the next slide. So this is your overhead resistance, 450 to 420 on the SPY. That's been going back well over a year. This is last week's range. Actually, it's about 7 days worth of range. On Monday, slightly higher, but we still had negative breadth. Tuesday, slightly lower, but the worst breadth of the week. Gap higher, fail, rally, strong rally on Wednesday, but still slightly negative breadth. Most of Wednesday, flat. Yeah, it went up and it came right back down. And then another one of those end of the day kick save. And that turned out to be the best breadth of the week. Gapped higher Friday, looking okay, above the 420 level. And then debt ceiling negotiations collapsed. Yellen says something about the banks, we tank. And then the rest of the day, it's your Friday snooze fest. So for the week, this is 1.7% up. But slightly higher on Monday, negative breadth. Slightly lower on Tuesday, worst breadth of the week. One of the strongest rallies of the week on Wednesday, that opened my eyes, negative 10 on breadth. New highs versus new lows. Now the next day, high, and that was the best breadth of the week, plus 92. Yeah, we're not lighting the world on fire. The bull's on the field, but he's still kind of snoozing. Gap higher, fail, snooze fest, plus 57. Okay, again, better. So if we look at the breadth measures we've been looking at for several weeks, one of these did not look like the other. New relative lows for the equal weighted SPY versus the cap weighted. New lows for the equal weighted Qs versus the cap weighted. New lows for the mid caps versus the large caps. But the small caps haven't gotten any worse. Not getting any better, but they haven't gotten any worse in about a month. So for the week, the breadth, this is your heat map for the week from Unusual Whales. Look at what the big caps did. Microsoft, Apple, Nvidia, 10%. Amazon, Tesla, 7%. Google, 4%. Now that's two of those, so that's equivalent to 9%. Meta, 5%. The rest of the techs, they did very, very well. Cyclical, consumer discretionary, if you will. Most of those were okay. Nike had a rough week on earnings. Industrials did better. Financials, again, not out of the woods, but they're edging closer to the edge of the forest. Energy, basic materials, all those are your economically sensitive sectors. Those all did well. And where breadth was weak, hey, this is where you want to see weak breadth. The defensive sectors, consumer staples, utilities, real estate. So for the week, our risk on, risk off measure, and again, third week in a row, hat tip to Chris at Chiovaco Capital. This is the S&P 1500 composite. That's the 500 large, the 400 mid, and the 600 smalls versus the 3 to 5 year Treasury bond IEI. So it's a very clear indicator of risk off, COVID crash, risk off, last year, risk on, most of 2020 and 2021. And then now we're kind of in this what range, but this is a significant improvement this week. Still in the what range, but a little better. Like I mentioned, banks edging closer to the edge of the forest. So here's XLF, and we had a high, which is actually a lower high from before. Silicon Valley Bank fails, dangerous low, right in the middle of this support level that goes all the way back to the great financial crisis. Then rally, significant rally, lower high, higher low out of the danger zone, lower high still, higher low, again, that's positive. And now this looks a lot better at noon Eastern today. We had a higher high, at least settled around the same level. Now, the big banks weren't quite as positive. Lower high, lower low, lower high, lower low. And at least they've taken out that first lower low. Haven't set a higher low yet. A higher high yet. But at least they've taken out that first lower low. The regionals, not so much. Silicon Valley Bank fails. They just cracked. Lower low, lower high, lower low, lower high, and they haven't come back even to that first lower low. Not out of the woods yet, but again, they haven't gotten any worse. So we'll call that damning with faint praise. Earnings next week, a lot more on the retailers, so we'll probably get a better idea of how the consumer is holding up. Lowe's, AutoZone, BJ's, Dick's Sporting Goods, Williams-Sonoma, Petco, Kohl's, Dollar Tree, Best Buy, Burlington, Gap, Restoration Hardware, Deckers, Ulta, and Costco. Now, the big earnings event for the week is going to be NVIDIA. That's one of the big caps. That's probably the 8th biggest in the S&P 500. Speaking of earnings, let's go to our new earnings game, Jacked or Whacked. And let's look at Foot Locker. So this is the day before earnings where we had two potential resistance levels higher and 4 potential support levels if it went lower. One of them being down around the psychologically important 30 level. So what happens? It got whacked. And this is a different way to look at a risk-first mindset. Figure out, and now, first of all, you wouldn't want to buy something that's been knocked down 26% in a day. No way you want to buy something. But look at the risk reward if you wanted to perhaps look at a short sale. So if I short it at the opening and it gets down to those previous lows and or that 30 level, I got the potential to make 80 cents. But I'm risking $1.25 if it just goes back to the high of that day. So for every dollar I stand to make, for every dollar I put at risk, I only make 64 cents. There is no way I would ever take a trade like that. So the only winning move sometimes is not to play. And I got that idea from a 1983 film, War Games, starring Ali Sheedy and Matthew Broderick. And he plays a high school hacker that busts into the defense computers where it's a war game playing global thermonuclear war. And ultimately, the computer learns that there's no way to win, so it goes, strange game, the only winning move is not to play. And this is a key point to think of in your trading. If you don't have a good risk reward, the only winning move is not to play. Pass on the trade. So to recap for today, again, if the Fed is going to cut, something bad has to happen. Now that hasn't happened yet. Inflation is still high, it's still sticky. The market knows about all the bricks in the wall of worry, debt ceiling negotiations, sticky inflation, like I mentioned, war in Ukraine, political gridlock, the banks, yada, yada, yada. Is the market unstoppable? No. So those folks who are thinking that the snorting bull is back, not so much. Still, the big caps driving everything. Breadth is improving, but it's still flat at best. We're not on risk on. We're certainly not on risk on. Still in the middle of that what market, but getting closer to the risk on level. Financials not out of the woods, but they're closer to the edge of the forest. And then we looked at jacked or whacked, our new earnings game. So finally, as my buddy HONU always said, small losers win.